Yes, sir.
We fought very hard for that holiday. I think we should respect it.
Yes, sir. We'll do that, sir.
Thank you.
That's it. You got it. Thank you so much, sir.
Anytime, sis. Anytime.
Thank you, sir. So, good evening, everyone. Welcome to Medical Mondays with Dr. O. Welcome to another segment, the first one this year. And Happy New Year. I pray that this year will be amazing for us, that apart from learning and growing together, that every area of our lives will be much better than it was last year. So with that being said, I'd like to introduce to you one of our best around here. But before then, I am Dr. Toyin Okwesomi, popularly known as Dr. O. I'm a family practitioner, HIV specialist, and I treat substance use disorder in Maryland. I enjoy learning and also assisting in educating others so that we can grow and better our health. We know that strong health accords us a strong future. And last year, we found out that financial health is very important in our mental, emotional, and even physical health, and decided that we will, explore things we need to know financially. So we are blessed by one of our very own, one of our few Nigerian American multimillionaires in the US. Mr. Douglas Eze has been featured, wildly, on social media as one of our multimillionaires in the United States. And he's a wealth strategist, a very humble and unassuming brother who is always at the drop of a hat, always ready to assist, to do all he can to help us get financially sound. It comes with a wealth of knowledge, but I'm going to defer to him to introduce himself. And here goes Mr. Douglas Eze. Welcome.
Thank you. Thank you so much. Good evening, everyone. Now,
Good evening.
My name is Douglas Eze. I've been in the financial services industry for over 25 years. So I train a lot of financial advisors. I work with them, help them restructure their mindset, and so they could better serve the American community that we're in, actually. And I got into this industry. I was 24 years old when I got introduced to financial services. I was waiting table at IHOP. And when I got into the industry, I went and got all the licenses that was required of me to get. And I started doing what they told me to do as a financial guy, listening, learning. But finally, I decided, you know what? I need to start thinking outside the box and start looking out what do wealthy families do? Why is it that some families stay wealthy forever and it just continues to grow from one generation to the next? And being from Nigeria, and we have so many folks that, acquire massive wealth, but once they die, the wealth dies with them. Even here in America, almost the same thing. We have a lot of folks that are, wealthy, but when they die, if they're not informed, the government comes in and takes all. If you've ever heard of something called an estate tax sale, well, that means the family had to pay estate taxes. So got me curious about how do people like Johnson & Johnson, Rockefeller, all these families keep money in the family and still control it beyond the grave. So I just started researching wealthy people. And I quickly realized, man, there's two systems in America. There's a system for the wealthy and there's a system for everyone else, you know, and there's the informed and the uninformed. And just to kind of give a quick history lesson on taxes, because that's a big part of, I call it a financial hole in people's financial bucket, you know, because if you think about money, you got to look at money like water. See, water, when you put water in a cup like this, the water doesn't want to sit here. It's saying to me right now, drink me, use me to clean the house, do something. If I ignore it, it's going to start evaporating. And after months, years, there's not going to be a single drop of water in this cup because it's all evaporated. If I poke a small hole in the cup, the water is going to drain out pretty fast. Before you know it, all the water will be gone out of that cup because water doesn't like to sit. Well, one second, somebody's at my door. One second. Okay, they got it. So with that said, you know, money is doing the same thing that water does. Money doesn't like sitting around and doing absolutely nothing. Either you're saving money or spending money, right? That you save it or spend it. Now, there's a difference between saving money and investing money. So a lot of people get confused. I want to invest. And they jump into situations that they know nothing about. And then when they lose money, they start saying, wow, you know, I lost all this money. One thing I realized real quick, you know, researching wealthy families, I realized wealthy people do not lose money. They don't like losing money. You know, Warren Buffett said something very unique on one of his rules for investment. Rule number 1, never lose your money. Rule number 2, do not forget rule number 1. There's a reason why they do that. The government, the media, and the banks, all three of them work together hand in hand to basically move your money away from you. Because every industry, when you think about it, they're using other people's money everywhere. We all came from Nigeria. We came from a system where we use our money to make purchases. We want to buy a car, we save up and we buy the car. We want to rent an apartment. We save up for 2 years and you rent and you pay for 2 years rent. You want to build a house, you go get cash and you build the house and you pay cash for it. So when we come to America and they tell us about credit, we're like, what does that mean? My cash is not good here. They're like, you need to have credit. Well, here's the deal. Credit is queen, cash is king, but they can't do anything if they're not together. That's why they gotta get married. They gotta be married to make money babies for you. That means when you have cash and you have credit, you could make a lot of money by using other people's money, because now you could leverage your cash while using your credit to get money. We want to talk more about that. So what I want to do real quick, just to jump right in, and I wrote a book too called Creating Generational Wealth. Creating Generational Wealth. What the super wealthy know that you need to know. So it's we sold a lot since it's still, people are still buying the book till today. They still, I mean, we just got another order today for about 300 copies. I wrote it in 2014, you know. So when you read the book, it opens up your mind, you know, to a lot of things. So I'm working on the second one right now. So not bad for, and by the way, I have a PhD. So I know all of you are doctors. I have a PhD. How many of you have PhD on here? Public high school diploma. Anyone has that? Have that. All right, cool. So, you all see my screen, right? So what I'm doing here, what this is what I call your personal economic model. Everyone has it. Those that understand it use it to cultivate and build wealth for themselves. Those that don't understand it pretty much live paycheck to paycheck. So what I want to use this for tonight is just talk about, I call it finance 101, right? Just to kind of go to something that is very dear to our hearts as Nigerians and here in America as well, you know, when it comes to how we use our money. So we're going to talk, so there's 4 tanks here. One tank that says lifetime capital potential tank. This is all the money you're going to make in your lifetime. So your money comes in from your job. It goes right in here. If you have a business, it comes in through this lifetime capital potential tank. That's why this tank is bigger than these 3 tanks, right? And the second one is investment tank. And if you notice, it says risk on there. Because when you invest money, that's called speculation. A lot of times people say investing is compounding interest. No, it's speculative interest because you really don't know what you're going to get when you invest, when you take risk. And if you notice, there's no cap there. You know, that means you could make a lot of money. You could also lose a lot of money. That's what investment is. Because when we're investing, we're gambling to see how we're going to make money. We invest in our business. A lot of you, some of you are business owners. I'm sure you know that your business is actually an investment. Sometimes you make money, sometimes you don't, you know, all kinds of stuff happen. Then you have this other tank here that says safe, you know, and it has a cap on it. Well, because any money that goes into that tank is supposed to be safe and secure. That means you should never lose the money. Unfortunately, for so many people, when they save money in this type of tank, they make money, they save it up, and then an emergency happens, they need to put a down payment on a house. They go in there and they drain the tank. You know, another emergency happens, your car breaks down. You go in your safe tank and you pull the cash out. So now you just lost the power of compounding interest. So when you save money on a consistent basis, that's called compounding interest. When you're getting interest on top of interest, that's different from speculation. All right. And then we have this one, borrowed funds, this tank. This is basically borrowing money. So let's talk about that. Let's go into this. So when it comes to financing, all right, do you know that you finance everything you buy? See, a lot of people don't, when I say that, people are like, what do you mean I finance everything I buy? You finance everything you buy. Sometimes, you know, we pay cash. You might pay cash and you're like, well, no, I didn't finance that. I pay cash for it. Well, let's understand that when we say that, right? So when it comes to cash, let's look at this, for example, okay? So you either borrow from a lender and pay interest to the lender. So either you go to a lender and you say, hey, I want to borrow money from you, and you pay interest to buy what you need to buy. You pay him interest for loaning you the money. That's where banks come in. And then, or you say, you know what? I'm just going to use my cash to do it. I don't want to borrow money from anybody. I don't want to pay any interest. Interest is bad, you know, and we listen to some people on TV, radio in America, and they say, cut off all your credit card, don't have interest. And then you listen to somebody else and they say, you know, there's good debt, there's bad debt. There's, you know, debt is good. People get confused and like, what am I going to do now, right? So as God has blessed me with, you know, this knowledge coming into America first, you know, living in Lagos, Nigeria, grew up in Lagos, went to Jakonde school, you know, grew up with my Yoruba friends. So I have 2 brains. I have Yoruba brain and Igbo brain. So I kind of put those 2 together. So coming to America, those 2 brains kind of helped me a lot. I say, you know what? I need to do things differently, not the way these people are talking about, because I need to sit back and look at the whole picture. So you save interest by paying cash, right? But guess what you did? You also lose the interest you would have earned had you not drained the tank. Because think about it. your money was safe in the tank, earning compounding interest. But now when you take it all out, you also just lost the interest you could have been making on that. But I know you might say, well, you know, the bank don't really pay me that much interest. I understand. We won't address all that. So let's look at a scenario to illustrate this concept that you finance everything you buy. We're going to assume the following, all right? So this is the assumption. We want to purchase something for $30,000. Let's say it's a car for $30,000. And the financing rate is 5%. And you have 60 months to pay back, 5 years. And the monthly payment is $566.14. There's no extra payment, but we got to look at opportunity rate, which I call opportunity cost. See, what is opportunity cost? For every dollar you could have saved, but you end up spending that dollar, imagine what it'll be worth in the future. That's what we call opportunity cost. All right. So in this case, we look at this 30 grand, you saved it in your tank, and you need to make a purchase for that same amount. That's your choices, right? 5% interest. So, and your monthly payment, $566, like we talked about. So we're going to look at this. So 2 options. You could pay cash, which will also require you to drain the tank. Draining the tank resets compounding. So let's look at this. Or you could say, you know what? I want my money to keep earning interest. I don't want to touch my 30,000. Let me use other people's money, OPM, and pay interest to that person. When you do that, you maintain control. So now let me give you all this real quick, okay? The key to wealth building is own nothing, control everything. Own nothing, control everything. Control is the key. If you remember anything I say in this call, remember control. So whenever you're putting your money anywhere, always ask yourself this: when that money leaves my hand, do I still have control of it? For example, when you put money in your house, some people pay cash for their house because this is what we've been taught from Nigeria back home. Pay cash, don't have debt, pay off the house. And you do that. The question that you should ask yourself, how easy can you go get that money from the house when it's paid off? How easily can you get it? Is it liquid? Is it earning any interest? Do you still have control of the money? That's a conversation just to think about. So in this case here, our friend decides to finance. So when he financed, he borrowed the money from the bank. They gave him 30,000. He left his 30 grand earning compounding interest, and we're using a 5% rate on this. And you see his money on the safe tank grew to $38,501. He still maintains control of his money. He paid the bank. The bank said, okay, we get it. We're going to loan you $30,000. He took the bank's money. Now, here's this, folks. Banks make money loaning money out. That's why credit is very important. When you have great credit, you could get money at a cheap rate. So in this case, this person has money and also has credit. And because he has money and credit, he was able to get a loan from a bank at a good rate. So in this case, we're using 5% rate. And they said, okay, at the end of 5 years, you're going to pay the bank interest of $3,968. The interest that the bank lost is $4,533. They lost that because they didn't have the opportunity to invest that. They just made money off of the simple interest that they made, or I call it the amortized interest that they made off of loaning you the money. And listen, I'm not upset with no bank for loaning money. right, to people. I actually love when banks loan money out to people, because that's how, as an investor like myself, I rather use the bank's money than use my money. So in this case, this guy kept his money and he still has full control of 38,501. So if you all notice something that he did, he had $30,000 here, but he told the bank, listen, I don't want to touch my money. I want to keep my money where it's at because I'm earning a better interest rate, but I want you to give me your money. And we use the same interest rate. At the end of the 5 years, he walked away with 38,501. And whatever he bought with this money, he's added. He could have used it to buy an asset, that is going to make him more money, or it could have been a liability, like a car. Well, if he puts it on two road, now he's making him money. So whatever, right? And he said, I could pay $566 every month. I don't mind paying that. That's nothing for 60 months. In fact, he even wanted them to give it to him for 72, 84 months, 90, the longer the better. He don't care about that. A lot of times we don't think about those things. So now we go to the next screen, and it just says here real quick, compare the following: cost of purchase versus tank future value, and which offers the most control. Of course, the savings, you have more control. Now, what if I make extra payment to the bank? All right, what about extra payments? It doesn't have any effect on the total cost. The 30,000 doesn't change. See, this is where the media have gotten people's mind and the bank. See, always remember, your hard-earned dollar that you're bringing in from your income or your business that's coming out from that side right there, that big tank, you got to secure that money. You shouldn't be giving it away. See, this person here is saying, oh, I'm going to make extra $200 payment because I want to lower the interest. All it does is change the payoff period. You get to pay it off early. But why? Why do you want to pay it off early? Well, I don't want to pay the bank interest. All right, let's see. Let's see the scenario. Let me go back here for a minute. So as you can see, interest paid. You still pay the bank interest. Okay, you didn't pay $3,000 in interest. You paid $2,800. Do you think the bank is sitting in the corner crying and saying, oh, I only got $2,800? Banks make money loaning money out. So for example, this amount here, if this was sitting in Bank of America or whatever, this 30 grand, I promise you, Bank of America took that 30,000, loaned it to somebody to buy a car, loaned it to somebody to buy a house, loaned it to somebody on a credit card, loaned it to somebody to get married, to do wedding. They make money all day, every day. That's how banks make money. They make money using other people's money. Every dollar you earn is going to the bank for interest. 34% of your dollar is gone in interest. So why should I pay them extra $200? You know what you should be doing with that $200? That $200 needs to be going into your savings tank. Should be going in there. See, a savings is a place you save money and you wait patiently for the next opportunity that's going to present itself. Because when the opportunity comes, how many times have you had an opportunity that came in and they said, man, you need to invest $10,000 to make 50 grand, or your friends call you up, let's invest in this property, and you just need $20,000 to put money in here with us, and we do it as a group or whatever. And you're like, man, I wish I had $20,000. You start because you know why? Because you've already transferred all your money to someone else. So be in the position of control where your money continues to grow and earn compounding interest. Now, what about, if I get what about high yield? Higher gains in tanks, higher level of control. So if I'm getting a high interest rate on my tank, or my savings tank, and because I have great credit, this is why credit is so important, you could borrow money at a lower rate. See, credit is king. I mean, credit is queen, cash is king, but they got to be married together. Once they're married, you could now make money babies. 1.9%, same example. Again, he only paid $1,000 in interest because he has good credit. All right. And you still have higher level of control of your $30,000. It's still there. Now, what about lower yield? What if I'm getting a low interest rate? Because I know some of you are probably saying in your mind, well, I don't have a bank that pays 5%. Well, so 1.9 or even 2% or 0.025% interest rate, no problem. Well, what about lower yield? Well, of course, you get lower gains in tanks, see? So your account grew by $2,987. You still have your $30,000. You still have control of your $32,987. You still have full control of your money. And yes, you paid 5% interest to the bank. You're still giving them away $200. So the bank still made $2,819, but they still lost $2,045 because they didn't invest this interest because they had to wait 5 years to actually get all that money. Remember, because you're paying them every month, every year, they're getting their interest little by little. And then when you add it up in 5 years, that's a 2819. So the money didn't have time to compound if we're looking at it that way. That's what we mean by this interest lost. I hope that's making sense. So what if I want to just pay cash? I don't like borrowing money from a bank. Well, you don't like paying interest, right? You don't like paying interest, yes. Well, likes earning interest must drain tank, killing compounding. So what happens? He drains his tank. Now you have no money. You drain the tank to make the purchase, to buy whatever it is you want to buy. You lose control of purchasing dollars. And interest, you lost interest account was earning. The interest this account was earning, you lost that too. It's gone. So now what do? You start trying to save back the money. To save it back. You want to get back to the position you were before. But unfortunately, not everybody is saving back the money plus the interest that they lost. See that? He didn't make no interest on the money. He actually lost $8,501. He saved back his $30,000, but he lost $8,501 because he didn't get that back. Because a lot of times when we put money back into our savings, we don't put it back in with interest. So we lose the interest we could have made on the money. That's what, when you drain your tank and pay cash, that's called self-financing. You self-finance. That's why we always say we finance everything we buy. You either pay interest to somebody else or you lose the interest that you could have been making on your money. So which one offers the most control of your money is the question. I believe for me, I'd rather use somebody else's money while I continue to earn interest on my money and have full control of my money. So with that, things to consider, assuming you earn the same rate of interest you would have to pay if you borrowed the money. The cost of whatever it is you're buying will be the same. So if you're getting the same rate of interest like we looked at earlier, everything will be the same. When you pay cash, paying cash drains the tank and resets compounding. One thing I want to remind everyone is always remember, the only thing we as human beings have is time. Time is very important. And every time we lose time, we can never get it back. And always think about inflation when it comes to your money. Your dollar today is more valuable than your dollar in the future. Your dollar today is more valuable than your dollar in the future, which basically means your dollar today needs to be making money. It cannot just sit around and do absolutely nothing. You got to give every dollar you have a job. All right. So when you pay cash, you drain the tank and you start all over. It's like running a race. You save and you drain the tank. That's, you're resetting the compounding interest. If money in your tank could earn more interest than it costs to borrow, consider the opportunity cost of draining the tank plus giving up control. So if money in your tank could earn more interest, if you could make more interest on your savings tank than it costs you to borrow the money, you should consider the opportunity cost of taking all the money out of this. Don't do it. Just borrow the money. That's what we're saying there. Maintaining control of your money may even be worth paying higher interest. Maintaining control of your money may even be worth paying higher interest. I know so many people that are buying a house, right? They're buying a property. And the loan officer, because people get advice from different people, all of a sudden, you're getting financial advice from a loan officer. And he says to you, well, you could buy down the interest rate on this loan. Like, really, I could buy down, and you cough out $20,000 to buy down interest. Why do all that for? Keep the interest where it's at. Keep control of your 20 G's. I only put down the lowest amount of money that I need to put down to purchase a property. I don't give them any extra dollar more. Even when I buy a car, the same thing. I give them the lowest, just title and tax. That's it. Whatever it is. I don't give them anything extra. In fact, I have them finance the car to the longest time possible. 92 months I'll take all day, every day. It's, the difference is what I do with my extra money. I rather keep the money in my compounding interest account and let it continue to grow than keep this empty. I need to maintain control of my money. If it costs more to borrow than you can earn, perhaps you should consider other tank alternatives. So if it costs you more to borrow money than you can earn, you should look at other places that you could have your savings in. Unfortunately, because we've been so trained with the media, the bank, and the government, all three of them work together. All three of them work together. Think about it. When you go start a job, the first thing your job tells you is, hey, you need to do direct deposit into your checking account. Oh, I don't have a checking account. All right, go to the nearest bank and open up an account. And you walk to the bank and the bank say, okay, oh, you got a job. Okay, cool. Here's the form filled out. You can start a checking account. Oh, by the way, you can also have a savings account. You start saving. In fact, you know what? Open up a savings account for your children. And you walk in and open up a savings account. See, that's the system. Because now you're pulling your money into the bank, and then the government with the same job immediately notifies the government that you just started working there and you are going to make 6-figure. The government say, oh, great. Thank you for coming in. And he owes us 25% of his income, or 28% or 30%. So make sure you take that off his paycheck before he touches it. If it costs more to borrow than you can earn, perhaps you should consider other tanks. And there are other tank alternatives, but you don't hear about them on TV and the media. They don't tell you about those accounts. Paying cash is financing. It's called self-financing. When you pay cash, you just self-finance. So the best way I always explain this is when you pay cash, you're borrowing money from your future person. See, every time I pay cash for something, I'm saying to myself, Douglas, you just borrowed money from your future person. So now you need to pay him back every dollar plus interest and make sure you put all that money back in an account that's going to earn compounding interest. So basically, I replenish all my money, because when I get 10 years from today and I'm still alive, guess what? My future person, which is me now 10 years, will be looking for that money and say, dude, what happened to the money? You didn't replenish this account. This is why so many people end up working at McDonald's, Walmart at age 65, because they run out of money and because nobody really helped. So it's always good to think about every time you pay cash, if you don't pay it back, you just stole money from your future person. All right. Any questions for me?
Oh my, I have questions, and I'm sure others would have questions. Look, if you have questions, you can raise your hands to ask, and you'll be called on to ask it yourself, or you can, write it in the chat box. But if you put down the slides, I think you can put down the slides.
Okay, put the slides down.
Yeah, it helps me be able to see people better. Oh, there you go. Oh, I had a question, but anyone that raises their hand, gets the first go. So our very own Madam VP, Madam CEO of NAPAC. And by the way, in case people don't know, I am the chair of the Nigerian American Public Affairs Committee in the DMV, Delaware, and Pennsylvania corridor. Actually, Douglas is also a member, and Madam VP, Madam CEO is our mama, our mother from California. So she has a hand raised. You can go ahead, ma'am. Please unmute. There you go. Oh, you muted back. There you go.
That's what happens when we haven't had Medical Monday, two Mondays.
I know. We withdraw. Happy New Year.
Happy New Year to all my brothers and sisters on the platform. And Mr. Eze, good to see you again.
Yes, ma'am.
Yes, my question, thank you for the introduction, the presentation. I want to ask about the interest compounding account, because in the bank, we know they're shady, but the only thing they offer you is either the CD, which is right now rolling about 3% if you're lucky. But I don't know what the future projection is, but what other account or bank has a better interest rate that you could ask them? Because they're not going to volunteer the information unless you ask them.
Yeah, definitely. Like you said, CDs is somewhere, that's one account. There's money market, there's different accounts like that. There's also the one that I like best, that I use, my favorite out of all these different accounts, is cash value life insurance. That's my favorite account. And I use that for a number of reasons. One is the fact that every time I earn interest in that account, I don't pay any taxes on that, because a CD, you got to pay taxes on the interest you earn. A CD, you don't really have control of the money. There's penalties and all that stuff if you take it out before the CD matures, right? So those things, I don't like control. I don't like anyone telling me when to get money when I need it. And
yeah, but the cash value life insurance also has a penalty if you take any money out. You just don't pay. Okay, I see what you mean. You don't pay tax on the interest accrued.
No, actually, you know what? That's a good question. No, it does not have any penalty.
It doesn't have penalty, no.
Yeah, it doesn't have any penalty when you take money out of a casual life insurance. Because here's the thing: there's two ways you can take money out of a life insurance policy. You could take it as a withdrawal and just withdraw your money and walk away, or you could take a loan against it. So let me help you out with this for a quick second, right? Think about life insurance like a mortgage, like a house. all right? You go out and you buy a house, $300,000 house, all right? No problem. You have a monthly mortgage payment, let's just say $1,000 a month. All right, there's 3 ways you could pay for that house. You could either pay interest only, you could do principal and interest, and you could make extra payment. So if the $1,000 is the monthly payment, $500 of that money goes to the interest, the other $500 goes to the principal, which is the money that is helping you reduce the amount that you owe the bank. The $500 goes to the bank as interest. Now you might hear somebody on TV, they say, hey, you could make extra payment and pay your house off quickly. You could put an extra $1,000 in there, no problem. Now $1,500 is going towards the principal, and the other $500 still goes to the bank to the interest. The only problem with that situation is you do not earn any interest on the $1,500. And no matter what you do, your house is going to appreciate the same way based on the neighborhood. So that's one. Now, life insurance, the same example. You buy life insurance on your life because you as a human being, you are an estate. When you have a social security number, you're an estate. See, in 1913, the government said we're going to charge people taxes. Income tax was introduced to America. 3 years later, inheritance and estate tax was introduced. So when we die, the government adds up everything you have and everything is tied to your social security number. Your family will have to now pay what they call an estate tax. So you as a human being, you are an estate. So let's say again, using the $300,000, you want to protect your estate in case of death. No problem. Let's say the same premium. We take the same $1,000 a month. $500 will go to the insurance company. The other $500 will go to your savings, which you call the cash value. And the insurance company say, hey, we're going to pay you interest on that $500. So let's say the interest is 4%. So that 500, the first 500 just went to cover you in case you die. That's like the one they call term insurance. It's like renting, all right? That's a 500. But you decide to make extra payment. So now you change it from term to permanent life insurance. Now you also say, okay, I could make extra payment to this because once you start that policy, immediately there's a maximum you could put in. And that maximum was set in 1980. So before 1980, there was no maximum. So wealthy people will buy life insurance and they dump billions and millions of dollars inside it because of all the benefit that insurance has, cash value life insurance. So in this same example, you say, I'm going to put $1,000 extra in it. So now $1,500 of your money is earning that compounding interest of 4%. So instead of putting the money in a savings account at your local bank, now you've turned your insurance as your own private savings account because now you have access to it. It's liquid whenever you want it, especially if it's designed properly. Unfortunately, a lot of insurance agents don't know how to design life insurance where it benefits you. They design it so it could benefit them. So, and that's probably why you asked that question.
Thank you. I guess I'm going to ask, can you assist us, any one of us, who want to set up this cash value life insurance to set it up properly?
Yeah, definitely. I mean, that's why I'm a Nigerian.
Okay. I've got to ask.
But yeah.
I keep telling you, I want a one-on-one, that I never had time to do. So I have questions.
All right,
Thank you so much. Thank you for that wealth of information. I know, we chatted on, there are so many topics to talk about. We didn't even touch trust or anything tonight. And thank you for the 101. This is amazing, incredible. So you were talking about bank interest the other time. You said, 30,000 yielded 8,501. What bank? Because bank interests are low. I don't know any that would do that over like 100 years.
Yeah. So, that was an example we used on the thing there, but we do have accounts that pay anywhere from 4%, depending on the type of plan that you're setting up when it comes to cash value insurance, all the way to some that actually are based out of using the S&P 500. So it just depends on the situation. So one of the things that I do that makes me unique and different from a lot of financial professionals is this. I help my clients find money in places that they might be throwing money away unknowingly because they don't know they're doing it, and unnecessarily we could fix it for them. So a lot of times there's so many financial holes in people's financial bucket. And unfortunately, when you run into a financial advisor, the first thing they're going to say is, how much money you got? Bring it. Let me help you invest it. And they're taking your money and they're dumping into this bucket that you have that's also draining with all these taxes, debt that you have, interest, opportunity costs. All this is affecting your money. A lot of times we don't even realize every dollar we earn, 30%, 34% goes to the bank in interest, credit card interest, financing the car interest, mortgage interest, student loan interest. 34% of your dollar is gone. Then 40% goes to taxes to the government. So between the government and the bank, that's 74% of your hard-earned dollar that's just transferred to them. And then you're left with 26% to enjoy your lifestyle. But you say, well, I want to save. So we only end up saving 3% of our income towards our future. And then we spend the other 23%. Now, again, you go meet the financial advisor, the first thing they'll say, well, you're spending too much money on your lifestyle. You need to stop drinking Starbucks coffee. And then they do the math for you. And they say, well, you know, if $5 a day is this, you're spending all this money. That's your happiness. And they want you to stop spending it. Or they might come, especially, you know, and say, hey, stop going to the Nigerian parties and stop doing your gele and all that. It costs you all
And
this
their
money.
Shebiz.
That's what makes you happy. You work hard for your money. Nobody should tell you how to spend it. See, what I focus on is the other two, the taxes and the interest. What if we could reduce the volume of interest that you're giving away? What if we get you out of debt faster than you ever thought was possible? So you could now save more money. If you think about it, the debts that you have, your mortgage debt, all these things, if you didn't have to have that anymore, showing you a different way to even pay off your mortgage without you using your money to do it, wouldn't that be a better conversation to have? And still enjoy your lifestyle and show you how to enjoy your lifestyle without feeling guilty about it either. So
thank you so much. I have a question here before I go to my next one. Our attorney, no, wait a minute. This is Dr. Ademola Oduyebo. Ask, how high is a credit score that should get him interest lower than 5%?
So it depends, you know, I mean, you know, anything over 700 is good score, and every bank is different depending on what's going on. You know, banks always have their own situation. You know, so it's always good to shop around, you know, of course, to see who's going to give you that's why it's important when you have money and you have credit, you know, then you could actually negotiate sometimes and be picky on who you want to use, who's going to give you the money at a better rate. And if everything fails, for me, if everything fails, I go into my insurance and I call the insurance company and they wire me the money. They loan me their money, not my money. You know, I know Doctor asked earlier, they're not giving you, you're not loaning your money. That's the mistake most people think. They think, oh, I'm loaning my money. Why should I loan my money? No, you're not loaning your money. You're using your money as collateral. As I call it, a secure line of credit. You're saying to the insurance company, listen, give me your money. I want to keep mine in your account because you're paying me a very good interest. I want mine to continue to grow while you give me your money to go do what I need to do. And the insurance company is saying like, okay, no problem, because the insurance company know one day you're going to die. when you die, they'll get their money. So they're not stressed about it. So they don't have to call you every day. You don't have to worry about them reporting you to the credit bureau. You don't have to worry about any of that. You could take your time to pay them back, or you could just wait, do whatever you need to do, and pay them when you die. Either way, it's not a problem for them.
Thank you. Oh, wow. That is very important. Thank you. Dr. Ajagbe, sir, you have your hand raised. Kindly unmute, sir.
Hey, Doug. Thank
Dr.
you.
Ajagbe is seen in Nigeria. Audience, Medical Mondays family. The man is still enjoying pounded yam and mala and all of those in Nigeria.
Yes, so thank you so much, Doug, for the presentation. Honestly, I can tell you what you've just shared is about the most straightforward, easy to understand concept than anybody has ever explained on this financial issue. Personally, I consider myself totally illiterate when it comes to finances because growing up, I don't think I ever learned anything about money or how money works or how money works even now. So I've done a lot of, I've put a lot of investment into finding out, and I'm still trying to find out more, which is the reason why I chose to be up to listen to Doug presenting tonight. Thank you so much for that. And I think if you have time, I still wanted to try to explain a little bit more about the opportunity cost. That's one, because I know sometimes when we were learning economics in high school, that was one of the topics they were teaching us, but they didn't understand how it really works. Right. So many of us might have been confused by when we just hear the term opportunity cost, we don't know exactly what it means and how it works and how it applies on a daily basis. So that's one. The second thing that I wanted to talk about is the 7-year rule. By the time you are doing your life insurance with cash value, to talk about the 7-year rule in relation to the maximum that you can, insure yourself for. Okay.
Very good questions. Very good. So the first one, the opportunity cost. So I'm going to bring my guy up so that this guy could help me with that. All right. So opportunity cost is this. So let's think about, I'll use $10,000. All right. So $10,000 in an account earning me, let's just say 4% interest. Over 5 years, my account is going to grow to by 2,210 plus my 10 grand, that's 12,210. But if I take that 10 grand and spend it, I just lost not just the 10,000, I also lost the $2,000 that I would have made on it. That's the opportunity cost. That makes sense?
Okay.
Yes, it does.
That's what it means. So the key is to keep your money growing and use it, and leverage it. And then if you notice, remember the other when I was talking about every time you save money, you keep adding. Instead of adding it to the bank, add it to your savings. The more you add money here to the savings, the more it grows. See that? That's the key. A lot of times people focus on interest. Oh, I need to make more interest. But instead of focusing on the amount that they're putting away. But so many people, instead of doing that, they say, well, I'm just going to go pay extra on a debt. And they go to the bank and they pay extra. And that money, their wealth is gone. So they end up not saving money. And they're where they are. That help on that part. Yeah.
Okay. Dr. Ajagbe, did that help, sir?
Yes.
Did that help, sir?
Well, kind of, but it's okay. I understand.
Okay.
I'm just thinking there might be other people on the platform.
No, just you,
who are
sir.
not-
Just
Yeah,
you.
it's
Does that
okay.
help?
I
Thank you,
understand
sir.
what it is.
Thank
And
you.
then the 7 pays for life insurance just means this. So there's in 1980. Now think about this for a second. Insurance has been around since the 1800s. That's how long it's been around. So in 1980, during Ronald Reagan era, again, you know how it is with politicians. There's always one person in the politics that says, oh, these rich people, you need to tax the rich, tax the rich. So Reagan said, okay, cool. We need to put a cap on how much somebody puts into life insurance. So the first thing insurance companies did, there was what they call a modified endowment contract, meaning if you go over the limit, then they're going to treat your life insurance as if it's a 401k, an IRA, 403b, those things. You know, maybe the next, if you'll invite me again, we could do an insurance 101, how insurance works. That will help you understand insurance even better than most people. So you could, you know, breaks down a lot of that. I could even do it now. It's 5 minutes.
You know, you just hit it. I think that's what I did, because I withdrew from the main deposit, and then you had to report it as an income to IRS. That's why it was taxed. I think so.
Exactly. You withdrew instead
Yes.
of loaning. And if you all think about when you borrow money from your house, that's called refinancing. When you refinance your house, you don't pay any taxes because it's a loan. So with life insurance, you could do the same thing and take a loan from the insurance company and say, give me your money, and then they charge you interest, but the government don't tax you. Now, here's the difference with the interest from insurance versus a bank. With an insurance company, they do interest only, meaning when I borrow money from the insurance company, every time I pay them back, 100% of what I pay them goes to the principal first, reduces my principal, and then they charge me interest on the balance of the loan on my anniversary. So basically, when I do real estate transactions, I normally do it multiple ways. Sometimes when I'm flipping property, that's what I choose to do. Or I'm loaning money with a group of my friends as a hard money lender. We borrow the money from the life insurance policy at a low rate, and knowing also that, hey, I have 12 months to put the money back, while we're charging people between 10 and 12% to pay us back. And if they pay us back because they're in a hurry to fix their property and do whatever they do, they pay back within 8 months. We put all the money back in the insurance policy and pay 0 interest to the insurance company because we paid it back in less than 12 months. But we made 12% on that deal.
Okay. Thank you. Thank you so much. Dr. Izugu, you're next, sir.
Yeah, thank you so much. Thank you. That's a very beautiful presentation. Thank you. Thank you. Actually, Dr. Jagbe kind of touched it again about the 7 year, MEC issue. Now, what is your advice on people if the 7 years is over, in terms of putting the money in the savings in the bank or putting them in the insurance? Because I mean, anyway, open to you, please.
Yeah, so definitely. So one thing that I teach, my clients is this: I don't ever do the 7 pay situation. The reason is, if you asked a great question, what should I do after 7 years? I like people to pay until they stop working. Because think about your money like a car, right? You go to work, you earn income. That income needs to go sit somewhere while you wait for an opportunity to present itself. So you buy a car from the dealership, you need to park your car in 2 places. You could have parked your car on the street or in your garage. In this case, the insurance is the parking garage. Why do we call it parking garage? Because it's safe and secure Nobody can touch the money inside a life insurance contract, and it doesn't show up on financial aid application. When your kids are ready to go to college, you could set up an insurance policy for your kids when they're babies, and it grows with them. So I like people dumping money in the insurance as they grow. And then once they turn 65 or they say, you know what, I'm done working, I don't work anymore. Then they could start drawing tax-free income from the insurance policy for the rest of their life. So you could set up another policy after your 7th pay, because the way they've designed the plan, the person that designed it only did it for 7 years, but that's fine. It's done. You don't have to put any more money in it. But the question now is, if you have extra money still coming in, where are you going to put it? You might as well start up a new policy. But one thing I'll assure you and want you to do is the money in life insurance is not an investment. It's a place to use the money to go invest and make more money. Make sense? So all my money in my insurance, it's quick access to it, because when an opportunity presents itself, I don't have time to go sit and be talking to a bank manager to give me money. I need to jump on that opportunity fast. That's what insurance allows me to do.
Wow. Thank you. Wow.
Okay, Doug, one more second. How about over insurance?
Over insurance, meaning you have too much insurance?
Could you get into a situation where you are over insured?
Well, so a person can never be over insured, meaning one, first off, we look at everything you have going. So there's different way we insure people. We insure based on your income. We insure based on, again, I say the minimum I could cover somebody without having any stress from the insurance company, meaning they don't want me to get the person's financial data and all this stuff, is 20 times their income. So if a person is making 100,000, they could get $2 million, which would be 20 times their income. Now I could get a little bit higher, but now I need to get financial document where we're looking at net worth and all the other stuff. And in some cases, some of my clients, we do what we call premium finance. Like I have a client right now that we're working on a premium finance day, which basically means we're going to a bank and getting the bank to give us money to buy this guy's life insurance. The guy's, he's worth about 40 million. So he's looking about getting a total of $60 million of life insurance. Well, the premium is going to be about $2 million a year for the type of policy that we're looking to do for him. But he don't want to write a check for $2 million every year for that. But we could borrow that $2 million from a bank to pay for the life insurance, 100% of it. And all my client has to do is just pay interest, and that's it. And post collateral. Instead of paying $2 million, he's like, man, I could do the interest every day. And he only has to do it for 10 years and then he's done. After that 10 years, the bank pays the insurance policy for 10 years and the bank is done. And then we use the cash and the policy to pay off the bank. And then he's going to start receiving income for the rest of his life, tax-free. So there's things you can
Absolutely. Do. Yeah. Thank you.
Thank you. And Dr. Jagbe, by the way, thank you so much for the amazing missions you did in Nigeria, in Ibadan. And,
Ondo.
God bless you, sir. Thank you. We appreciate you.
Thank you.
Sister Tina, kindly unmute and ask your question.
Yes, sorry about that. I was trying to unmute.
No
So
problem.
good afternoon. This is a very good, informative session. I'm so glad I joined. So I have a question. I noticed that my brother is only talking about insurance, and I wanted to ask a question in regards to real estate, because as you stated, you said if we refinance our property, we don't have to pay taxes on those on the refinance, right?
Yes, ma'am.
Okay, so my question to you is, in that case, why aren't we also using the money from the refinance to help other people get into the real estate business. For instance, let's say, like, I'm just giving a scenario, like Bill wants to buy a property, but they do not have the cash. They do, but you can help using your money, like since you refinance your property, so you loan Bill the money, and then you tell Bill, you sign a contract with Bill and say, well, after a year or two, once you build equity, I'm going to charge you 30%, 40%, because that I live in California, and a lot of my Caucasian friends, that's what they do. So they loan people money, and the interest rate is really high, because this is a channel where some people cannot afford to go to the bank because of their FICO score. And so they have to go to lenders, like you said. So why aren't we doing the same thing? Why aren't we using real estate? Because I noticed you didn't really touch upon real estate. So that's why I'm bringing.
So, yeah, no,
Okay, before you answer, Sister Tina, I just want to say this is huge. We're going to bring Douglas back over and over again. You know, we discussed this, the topics are huge. And what he has done tonight is give us a sniffle.
Oh, yeah.
That's why he called it. He actually called this session 101, that it's just foundation. There are still so many areas to touch. It will blow your mind.
Yes, it's already blowing my mind.
So real estate is not I mean, you could definitely, I refinance my house, you know, or my properties that I have equity in fast, and use it to do other deals and buy other investment, because sitting in the house is not making me any money. So yeah, so one thing that we do is, yes, you could refi because it's free money. It's a loan, basically. You're not paying taxes. When I say it's free money, it's tax-free money. You still got to pay mortgage on it. So I'll always remember with real estate, which is why another reason I don't really like parking money in real estate is the fact that no matter how much you have in your house, no matter how much equity you have, you can only borrow up to 70 or 80% of that equity. And you got to get permission. And just because you have equity in the house doesn't mean the bank is going to loan you the money. So instead, we prefer using cash value insurance to borrow money and do the same thing, because there's no stress. Unlike real estate, if I refi, I got to start paying the mortgage immediately. What if the person I give the money to decides not to pay me back? Especially if you didn't build it correctly and you loan, you know, because again, there's a reason why banks use credit in America, right? Because people lie and people don't pay back. How many people have we loaned money to that when they see you, they don't even call you back? They were calling you every day. Hey, please, sister, God, please. Only God is going to help. As soon as you give them the money, they forget that they call God so many times. You can't even get them to return your phone call. So that's why banks say, listen, if you don't have credit, that means you're telling us you are a bad person. You don't know how to manage your money, which is why when I came into this country, I had to understand the credit game. At first, I didn't know what it was. And I got jacked because I went to a timeshare presentation in Virginia. I can't forget those people, man. I saw these white people eating rice and stew.
Can you please, Dr. O, add timeshare to the topic?
Yes, ma'am. Yes, ma'am.
What people we gotta cover.
They gave me rice and stew, and I signed off. I'm like, Oyibo is chopping rice and stew. This must be good. And I signed away my life. I didn't know what I was signing. And they got me real good. And they put a judgment that messed up my credit. I had to file bankruptcy because of that stuff. Back in the day, I was only, 27 years old? But, you know, so after that, I said, you know what? I need to figure out this credit game. I understand how credit works in America. I took the time to understand it. And now credit is queen, cash is king, but they gotta be married so they can make money babies. All right.
Thank you. Credit is queen, money is king. I remember that. Dr. Akitonde, it's your turn. You can unmute and ask your question. Thank you.
Thank you so very much. I'm happy I joined tonight, even though I joined late. Thank you.
But you join all the time. You all join all the time, and you kept saying you're happy you joined. We're glad to have you.
Thank you. Thank you so much, big sister. Two questions, please. The first question is, could you confirm, is the current housing market favorable to the seller? My second question is, if the current housing market is favorable to the seller, who is not necessarily with a high credit rating, is refinancing going to be a problem?
No, I mean, so it's right now, it's a seller's, well, let me see. The interest rate is high, so people are not getting loans to buy a house. You know, some people don't want to buy because the interest is high, but you know what I always say is this. First off, don't buy a house based on emotion. Buy a house either because you're going to make money off of it, or it's just a place to live. A house is not an investment unless it's making you money. If it's not making you money, it's just a place to lay your head. That's it. So there's a lot of ways to get into that world. Now, if you buy a property right now with a high interest rate, that's fine. If you have renters in there paying for it, then that's fine, right? You know, because the renters are paying. Now, you know, if you're not making any money off of it, then that's an issue. So just take your time before you jump in there. But, you know, and if you're able to refi and you like the terms of the loan, and the question is, what are you refinancing for, right? So if the deal is not good, if I don't see myself, if it's not making sense and the monthly payment is going to be, then I wouldn't do it. You know, I wouldn't do it. So it has to make sense for what you're trying to do, you know, and how much you're looking to pull out of your house. Does that help?
Thank you, sir.
Thank you so much. So I'm going to call on Amazing Toyin, Mr. Daudu, sir.
Okay, it's a pleasure to join, and I am happy to hear all this outstanding advice. So I had a question that was asked a few minutes ago, where the young lady was asking, or if I have all this equity and I refinance my house and I want to loan it to somebody, because there are a lot of people doing it and they can get 40% return on their money. So the question, the lady didn't answer was, this 40% return, is it coming from a loan to the investors, or is it coming from a partnership? Because in California, you can charge more than 10% interest, even on real estate, you know. And if you're going to be in a partnership with somebody, you have to make sure the person knows what they're doing, and you have some kind of control. Mm-hmm. So when you loan the money, you make sure your money is safe to some extent. In other words, you don't loan more than 70% of the after repair value. So which means if the property is worth $100,000, the most you want to loan on it is $60,000. So if something goes wrong, you have a protective equity in the property.
That's right.
Okay. So what Mr. Eze stated, you know, is correct to some extent. You know, when you borrow money on your house, the interest is not taxable because it's not income. And so if you understand the real estate market, or you have somebody that understand the real estate market, and you could refinance your house for 5%, 6%. You could now put it in the market with an investor that understands the real estate market and make 10% on it straight loan. Or if you go into partnership, you could make 20, 30, 40%, depending on what partnership you go into. So that's the information that I wanted to share with the audience. That most people sit on their property, okay, on the equity they have, thinking that they actually have the equity. The equity you have in your house is not really money until you turn it into money.
That's right.
So I mean, give you an example. People that could have sold their property 5 months ago for 500,000, right? Because the market is down right now, they lost instant equity. Let's, for example, if you own a property, you only owe 300,000 on it. 6 months ago, before the rates start going up, you could get a credit line of maybe 100,000, at 60, 70% LTV. But today, if you go to the bank, your credit line, your equity that you thought you had 6 months ago, it's already disappeared because the market has gone down. So whenever you have equity, I always tell people that, look, if you have equity, you should take it out. You take it out in form of cash, put it in another investment that could give you a return, such that if you tap your equity in a property, for example, and your interest rate is a certain amount and your payment is 1,000, as long as you could use that money to make a return that pays you $1,500, which means you have a cash flow of $500 every month. Okay. So even if the market goes down, you already have the money working for you. Whereas if you need to take the money out, when the market goes down, you no longer have access to the money. You have to wait for another cycle. So that's part of the opportunity cost that Mr. Eze was actually talking about earlier.
Right.
So anytime you have the opportunity to tap the money you have, look for advice on how you could make use of that money so that it's also always working for you. Because your money is like employees. You throw them out there, they go to work and bring you money back. But if your money is not making money for you, you're basically throwing money away. So I hope.
Yeah, if I may add to it, Doctor, sorry. These are radical concepts. They work for those who know how to toe the line. So you don't just get up, go take money out of your equity. If you're not a good risk taker, you stay where you are for this, And also, I want to ask for those who want to take money, take equity and loan to others, what structure do you need to have in place in terms, because it's not just a partnership agreement, because if you run into bad debt, the person doesn't pay you back, that's a total loss. You don't have a way to claim that on your tax return. What structure does that person need to have in place? And I know Dr. Ho said this is an extensive topic. We're not going to get to everything today, but that's a very important thing to cover.
Let me answer that question real quick, please.
Okay, and by the way, for audience, the person speaking now, Mr. Daudu, is the real estate guru. One of the best we have in the nation. So go ahead, sir.
So I think Madam Vice President was speaking about risk, right? The number one place where banks put their money is in real estate. The reason is very simple. It's about the safest, one of the safest, I can say, investments in the country. The reason it's safe is because your money is to some extent guaranteed. If you loan money to somebody and they use the money to buy real estate, you get what is called a deed of trust. That deed of trust gives you the opportunity or the right by law to take that property back. And so if you loan the money with a protective equity of 40% and the person defaults, in fact, that's a bonus for you, because if you loan somebody 60,000 and they now give you back a property worth 100,000, you just made $40,000. Yeah. So, and so Madam Vice President talking about risk. Yes, not everybody understands the risk involved, and that's why education is so important, right? This kind of forum is important to get the initial information. Then you could do a follow-up with somebody that really knows, right? Or you could just go to Google the financial experts, study as much as you can, okay? And then look for how you can make it safer for yourself. If you got 100 grand to invest, you could start with $20,000 just to get your feet wet, without, so you go through the learning curve of eventually having to invest your 100,000 or 200,000, or be confident enough to tap the equity in your house, because most of the people in the nation have their wealth trapped in their real estate. It's as simple as that. Most people don't have cash on the side. The cash is trapped in their house. And the cash is trapped in their house because of the structure of the savings they created for themselves by buying a house. Everybody should own a house, or 2 houses, or 3 houses, right? For that matter, because that's the fastest way to actually create wealth in this country. Businesses are good, but they don't pay. They're in fact they're riskier than real estate.
Thank you.
I mean, that's another lengthy discussion, but I don't want to delve
that's
into it.
another discussion that we may need to take you up on in the future. So thank you so much, sir. Appreciate you.
You're welcome.
Douglas, I want to run through the questions in the chat box really quickly. If you give us, boom, answer. So Dr. Booker says, how much money does one inherit prior to paying income tax?
Inherit? I don't understand.
Dr. Booker, what do you mean?
What I'm saying there is, if you sell a house or you inherit something, there's a certain limit that you could get prior to paying income tax on it. What's the gift tax then? How much is it?
All right, everybody back to the garage for video.
I think it's up to 600,000. Am I wrong?
So when you say when you sell the house, or you're giving
No,
it?
let's say you inherit, like your mother dies and you get money from selling her house. And that's how much do you have to pay on inheritance tax? We have a certain amount that is allowed before you pay taxes.
That's a great question for your CPA, your tax professional will be able to answer.
And you know what? We have.
And secondly, I agree. I'm married to a business person, so I had some ideas of what you were saying, but you explained it simpler for me. And I know he has borrowed from his insurance for the business. So people who have businesses, they can borrow from if they have an insurance policy. And it's good for most people, I could say from experience, to insure, like my father, my mother, that's some easy, well, it's not easy cash, but when they pass, you inherit that tax-free money. So having insurance policies on other people is usually a smart thing, in my opinion.
You know what, Dr. Booker, I'm going to help out with this. That's a separate topic. That comes under trust and stuff like that. You just opened a can of worm.
No, not necessarily. Like you have, I had 50,000 on my father, something when he died. I was able to pay for the funeral, but still get some cash. What I'm saying is that if you take out an insurance policy, not necessarily a term, but a whole life or universal life, you could gain money when they die. Mm-hmm. Am I wrong?
I
know I'm not, because I got some money.
No, you're right.
Mm-hmm.
You're right about that. But that's a different huge topic, insurances. That's why he said, when we bring him back, he thinks he's going to talk on Insurance 101. And I think that will come under that. But you are absolutely
okay.
Yeah. So Dr. Duyebo says, which is better, lending, bank or credit union?
Whoever is going to give you the money fast.
Okay, so
Credit unions normally, have they normally give you, better rates sometimes. I mean, whoever gives you the money, it doesn't matter. Whoever's going to give me the money at the better rate is where I go with. I don't have any, doesn't matter to me. As long as you give it to me when I need it, I use it to do what I need to do, and I put it back in. So, and whenever you borrow money, you pay it back. That's all it is. And also, just to also say this too, so everyone will know, the U.S. life insurance company, have more assets than all the world banks combined. The U.S. life, just the U.S. life insurance company, they have more assets than all the world banks combined.
oh,
So
wow.
think about that for a second.
Mm.
And banks have a whole lot of money sitting in life insurance cash value. There's something you should Google. It's called BOLI, Bank Owned Life Insurance, BOLI, BOLI. Banks buy a lot of life insurance. Warren Buffett spends about 600 million every year buying life insurance.
Wow.
And
So, a lot of people keep money in the real estate because if you have a lot of money in the bank, there's this FDIC insured, and your holding in the bank, if you exceed 100,000, in the event that that bank goes belly up, that's all you're entitled to. So where do you balance the investment opportunity if you're not good at shopping for real estate? Because it's almost like stock exchange. It's volatile 1 minute, and the more volatile it is, the more return you get. But at the same time, you got to be watching like a hawk every day to make sure you're able to move money where it's doing well and where it's not doing well.
Madam, real estate is not like stock market. They're completely two different animals.
It's not. And that's why don't let's go there tonight.
Yeah, that's not the comparison I'm making. I'm just saying you gotta be watching the money. No, of course not. But I'm saying where.
Okay, you're talking about stocks, ma. And
no. I was just saying that in terms of the vigilance with which you're watching the investment. My question is really
which
about
investment? Which one?
At the bank, they always have this notice that says FDIC, that if your money or your savings or your whatever you have in there, they will not insure it beyond 100,000. Are you guys aware with that?
So what the bank is saying is this: if you have 300,000 in your bank account, 500,000. If the bank goes out of business, the bank files bankruptcy and they go out of business, you can only get up to the 250 or 100,000, whichever one they have there. That's what the FDIC insured is. But it still doesn't protect you from somebody putting the IRS putting a tax lien on your account. Doesn't protect you if you're going through a business dispute or anything like that, or divorce, whatever, doesn't protect you. It really protects if the bank goes out of business.
I want to quickly go through the questions in the chat box so we can cover that. Dr. Mary says, are there some criteria that could disqualify anyone from receiving cash value life insurance?
Anything that could disqualify some? Yeah, your health. So your health is your credit when it comes to buying life insurance. So if you don't have good health, if you have health issues, then you might not qualify for life insurance, the type that you would really want. So there's a lot of people that have money and they have bad health, they can't even get life insurance. Or even if they get it, then it's going to cost a lot more at that time because of their health situation.
Even high cholesterol, I've seen some people cannot get life insurance because their cholesterol is high.
Yeah.
So yeah. So Auntie Susan Oshifade said, thank you very much for the analysis on finance. She says she has a finance advisor, but she needs a second opinion on things like IRA versus life insurance. Please, she would like to follow up with you. So if you please give us the information to follow up with you, that would be fantastic. If you can please post that in the chat box, that would be great, so that everyone who needs to follow can follow, please. Attorney Richard Williams says, thanks for the excellent presentation. How advantageous is self-financing a project in Nigeria instead of borrowing to complete the project? Consider that you don't pay taxes or other assessments on completed projects or developments in Nigeria.
So when we talk about, self-finance, paying cash, because you already do that in Nigeria anyway, you're paying cash for projects there. I mean,
I think it's asking borrowing here to invest to complete that project in Nigeria, as opposed to paying cash to do it. Which one would you recommend?
So, I mean, first, I don't, banks won't give you money to go to Nigeria and do anything. But if you have money already in cash value insurance companies don't care what you do with the money. You could use it to go invest wherever you want to invest it in. But here's the deal with self-financing. When we talk about that, when you pay cash for something, what I do is I treat that money as if I borrowed it from a bank. And then I start paying it back to my insurance. But I have about 19 life insurance policy, so I use them a lot for different projects. I'm heavily invested in life insurance. I have real estate as well, because we do a lot of deals with real estate. But life insurance is an asset class that a lot of people don't even take advantage of because they just don't know about it. So, or understand it well, but it allows you to do so many things, that normally you wouldn't know what to do with. For example, you could, anytime you want. I just bought a land here. So not a big land, it's like 3-acre land. But the person was selling they put a price up. I called my agent. I said, listen, this land looks okay, let's check it out. And that's another thing, when you're buying land, make sure you check it out. Don't just jump and buy land just because somebody said buy land. Do your studies on it to make sure the land, you could build on it. How you could get water or all those things in there. So, but I got it was a good deal. They put it it was at the market for $120 when it came out. But I bought it for $80,000. I offered them cash. They agreed. They bought it. Why did I buy it? Why did they agree to it? Well, because you wait for the opportunity. People are going to sell. In this particular case, the woman was older. She didn't want the land anymore. She was getting rid of all the land that her parents left for her all these years. She's already sold a whole bunch already. So she was like, I got to let it go. And boom, I was the first offer. And she's like, boom, let's do it. And I bought it through one of my trust, my foundation trust, which is a 501c3 entity. I bought the land, and I also just found out from the county that if I put a structure on it, we don't have to pay property tax. So we build something on it and use it and rent it out to women, that have domestic violence and still get money. My clients make money giving away money. I can't learn from that.
Fantastic. Fantastic. So, Sister Vinci says, when is the best time to have insurance for your kids? And what kind to buy that they can borrow from when they are of age?
As soon as they come out from the womb, put life insurance on them, and it grows with them. And
What
then
kind?
cash value life insurance, cash value, not term. Cash value, always think about cash value life insurance like a house. It builds equity, and it's very, very inexpensive for kids. Each of my children have two policies each, and my trust pays for all of them, and my trust is a beneficiary for all of them. And the type of trust that we structure actually does something even unique, because it gives them the ability to, the trustee controls it. So I'm able to pull money from each one and go do business with it and put the money back. It doesn't have any OGMA accounting or where, once they turn 18 or 21, it belongs to them. No, don't belong to them. It's my money. Don't belong to them. It's not their money.
So when do they get it?
When I decide they get it, they might never get it.
What?
It might be for them. It's for their children. It's called generational wealth. They're going to get the money I give them. And then this is for their children. And then for their children to even get it, we're going to put life insurance on all the kids. That's how you create generational wealth and keep money in the family forevermore.
So I can't wait for when you do the trust. You said it. That was where we're going to start tonight. I'm glad you didn't start there. It would have probably gone all over our head. So I'm glad. Dr. Ezugu, I cannot pass him. Dr. Ezugu, please ask your question.
Douglas says, I love you. I mean, this is the fundamental of building wealth in America. There is no way for us to come first generation work all this hard and then let the young ones mess up all that work hard and don't take care of the generation after them, our grandchildren, and bring a legacy that not only sustains here, but also sustains back home. Kudos to you. That is the key. And people should work with him and set up systems in place. That's what you do in America to be financially free. Thank you.
Well,
Thank you so much. Thank you. And again, thank you so much, sir. You were there the last conversation we had in December 2022, where people said, please, we need financial health. Thank you so much, Douglas. We are appreciative. And thanks, Dr. Ezugu. And his contact information is in the chat box. But I have this question for you that says, is real estate safe? Where does the insurance company have all their money invested?
So this is a great question. So insurance company, they don't invest to lose at all. They invest, they give money away to people to buy real estate. They invest heavily as well in real estate, and bonds and, things that's going to give them guaranteed returns. They actually, the amount of interest they earn on all their money is about 10% guaranteed. That's how much they earn on the money that they have. So it's a great place for insurance companies to have money. They have different places. So, but think about it, they're making 10% on billions of dollars, and they're going to be around forever. So it's locked in. And then they also do other things depending on the type of program. So when it comes to cash value life insurance, there's two types that people use today. There's whole life, and then there's the index universal life. So there's two different types. The whole life is more for, like, I call that your savings account on steroids. And then the index universal life is more like a Roth IRA on steroids, right? So it gives you the same opportunity, the same benefit as a Roth IRA. It gives you the same benefit that you can use your money grows tax deferred. You could take it out tax-free without having to stress yourself about a whole lot of things. And there's no government restriction, like you would have in a traditional program, like a 401k or IRA or those things. And if you have business owners here, as a business owner, you don't want to be taking all the risk in the market anyway, because your business is already a risky business anyway. So you shouldn't be taking any financial risk on your money. You shouldn't be taking your hard-earned money and investing in the market. You shouldn't be doing that. You want safety, you want returns that is guaranteed. And there's a lot of ways you could invest. So a lot of times when we think about investment, we think about real estate. Now, remember, life insurance itself is not an investment. It's just a parking garage to park your money. But there is life insurance investment that's called life settlement, where you actually purchase somebody else's life insurance that might have a 3-year life expectancy. And banks buy that. Blackstone buys that. A lot of wealthy people buy it. 1 second, folks. Let me open this door.
So I'm getting that real estate is, well, banks invest in real estate. So you're saying basically real estate is safe, is a safe place to be, than stocks and stuff like that.
Yeah, I mean, yes, actually it is. But again, with everything, you got to make sure that because you buy real estate in some areas, you might not make any money. And a lot of people have lost money in real estate because they jump and they make purchases without really doing their research, understanding what they're doing. So, my best advice to people when it comes to real estate investing, find somebody that's been doing it for a while, and sometimes partner with people. Sometimes we want to do it ourselves and we run into a brick wall. Sometimes you might have to find companies that are proven. They might guarantee you a return, 5%, 6%, 8% return over 3 years or 5 years. That's called a buy and hold. But vet them. Most of these companies will allow you to invest with them if you're what they call an accredited investor. And a lot of you qualify, because an accredited investor just means you make over $250,000 income, combined income, husband and wife. You could become an accredited investor. So basically allows you to invest outside of the traditional investment, like a mutual fund and stocks that most people do. Now you could take your money and invest in alternative investments, so that's just one way, yeah.
Thank you. So Haman is from Britain, and he said he believes it is up to £85,000 is the value in the UK if the bank folds. That is the limit of money you get back. But then he said also that, do you have information? Thanks, Doug. Let me just read this so I don't mumble it all off. It said, thanks, Douglas, for the information you have presented. Can you give any information on your services in the UK? So can you give services to them in the UK?
Yes, we can. Actually, we do, like the life settlement, for example, right? That's a product, basically giving you an opportunity to purchase a US asset class. Just like you come into America and buy real estate, you could actually purchase people's life insurance policies. And there's a whole bunch of folks that have given up their insurance policy and sold it for, and made a profit, and they've walked away because they don't want the policy anymore. They don't need it anymore. So they sell it to a third party. So I buy a bunch of those policies actually. And so the company that I actually use, they supply a lot of policies to people like Warren Buffett. They supply a lot of policies to banks. Most people don't realize. I mean, Blackstone a couple of years ago put up $1 billion and bought a bunch of life insurance policies. So they do that. So that's a real thing where you actually buy some, and there's nothing. It's like you owning somebody's house, buying someone's house before they go into foreclosure. Same thing with life insurance. You could buy life insurance before the policy lapses. You could buy life insurance and get it from someone that don't want it anymore and don't need it. And the government actually likes that a lot because it's helped a lot of seniors able to get cash instead of just depending on Social Security. So the seniors can sell their policies to a third party.
So how would one know? How do you know where to purchase that? Is there a website or
No, you talk to Douglas Eze. So you know.
So I'm being asked on the platform about Douglas's contact. I just put it up there, you know, and for real estate, Mr. Toyin Daudu is an excellent one. I mean, it's fantastic all over the nation, and contact me if you want his contact for real estate. And you've got to get Douglas's book. I've posted it over and over, Creating Generational Wealth. Is that the one I have?
Yes.
What the super wealthy know that you need to know. You can get it on Amazon. Please do that. It's a wealth of information. It's still a hot cake, even though he wrote it in 2014. Thank you so much, Douglas. And thank you, Medical Mondays family. This has been awesome, Douglas. We're bringing you back, but we're bringing you back for a series. And Mr. Toyin Daudu, stay put, because we bring you on. We need to know more about that real estate. There's so much we don't know. So much. We will not be meeting next week. Oh my gosh, third Monday in 3 Mondays almost in a row, because like our big brother and very well respected attorney, our attorney Okusonya said, we fought hard for Martin Luther King Day. We want to celebrate him. We want to celebrate that day. We want to do whatever. And I will post to you a program that NEPAC California put together, if you can make it to attend, and to just enjoy some speakers.
Yeah. Thank you, Dr. O. I have a quick question for Douglas.
Oh, okay.
Just a quick one, if you don't mind.
No, sir, I don't mind.
Yeah, Douglas, thank you very much for a wonderful presentation. I'm just curious as to when do you collect if you buy somebody else's life insurance? Do you have to wait for that person to die before you collect on that money?
Yeah, man. That's the only thing.
Yeah. I kind of thought about that to say, that's a dark question, but I just wanted to
it's
be
good.
sure.
Yeah, that's when they die. So what happens is this: those type of policies are only sold based on life expectancy. So when you buy it, you're gonna know exactly what a lot of the people that sell their policy have health issues. They're older, they don't want it anymore, so they get it. They sell it for a little bit higher than the cash value. So, for example, let's say somebody has a $250,000 life insurance policy. That's how much he'll get, his family will get if he dies. And he also has in that policy, he has $75,000 cash value, and he's been paying on this for years. And he's like, okay, I don't want this policy anymore. I'm good. I need the $75,000. So if he cancels the policy, that basically the insurance company will send him a check for $75,000. The insurance company is very happy with that deal because they didn't have to pay out $250,000. But what if the person, before he sells it and he's watching TV and a commercial comes on, and you are probably seeing this commercial and you probably never paid attention, but you're going to pay attention and see it now, and you'll see it comes up. Different companies actually do commercials like that. And they say, hey, do you have an old policy that you don't want anymore, that you don't need anymore? Call this 1-800 number. And the person calls the 1-800 number and they say, hey, we could make you an offer for your life insurance policy. And he says, really? All right. Then they ask him to send them his health. They get his health. They check out his health. They go to his doctor. They get the medical records. They see everything that's going on about this person's health. Then they make him an offer, and say, we'll pay you $90,000 for your policy. And he sells it for 90, because if he had sold it, if he had canceled it, he would have only gotten $75,000. But now he's going to make a little bit more than $75,000, $20,000 or $15,000, $90,000. He sells it for that, and he walks away. Now that company becomes the new owner of that life insurance policy. But those companies are more like investors. They're not really interested in holding that policy show what they do and waiting 3 years or 4 years or 5 years for this person to die. They're not interested. They're investors. So they do what?
I hope they don't knock him out before
No, they don't. They don't need to. They contact somebody like myself and say, hey, do you have anyone that might have some money sitting in the bank or 401k that might be interested? And of course, we have a lot of clients that love policies like this. And we say, yeah. And then my client will buy it for a little bit more than the maybe 110, because the investor, they want to make them profit. So maybe buy for 110, and then they wait that 3 years. And when this person dies, the policy pays out. My client now becomes the owner of that life insurance policy. And during COVID, a lot of seniors died, and a lot of people made a lot of money during that time. And it's not mobile, because a lot of people, it's mobile. You've done them, actually did them a good thing, because they wanted to get rid of their policy anyway.
No, they needed the money for healthcare, for their residents and stuff like that.
Yep.
Thank you so very much. And with this, thank you for that question, sir. Excellent question. So till we meet again next week, please stay safe. COVID, I've treated so many COVID patients today. COVID is still raging. RSV is out there, and flu is out there too. Please keep safe. Mask up, in public places, even though they say it's mask free in some places where it's crowded. Please put on your mask and be safe. We'll see you next week. Oh, not next week, the week after. Sorry. Enjoy Martin Luther King Day. I would send the NEPA California event link